Misconception number 3. My advisor personally selects all my investments. Well, there's a lot more to the story. How your advisor selects your investments is generally driven by his or her compensation model. It's very important that you ask your advisor, or one that you're thinking about hiring, to email you and put in writing their compensation model and the methodology with which they are employing the management of your portfolio. Before we jump into the 4 types of portfolio management, let's dig a little deeper into how your advisor may be constructing your portfolio. It's very common for financial advisors to actually outsource the management of your portfolio to a third party. Sometimes that's referred to as an SMA, or a separately managed account. It's also common for financial advisors to delegate the management of your portfolio to their home office. Let's say your financial advisor uses an intermediary such as a broker-dealer or a registered investment advisor. Your advisor might not actually be selecting the investments in your portfolio because they may be outsourcing that portfolio management, or said differently, delegating the management of your portfolio to their home office at an additional cost to you. So it's really important to understand how your portfolios are constructed and whether or not any associated cost is also being charged to you. Lastly, it's important to note that it's very rare for an individual financial advisor to consistently outperform a benchmark or market indices. So it's really important to understand the construction of the portfolio and ultimately the tax efficiency of that portfolio if it's a taxable account, which, as was shared earlier, should be driven by your tax return profile. Let's talk about the 4 types of portfolio management. Generally speaking, your financial advisor will be managing your money in one of 4 ways, driven by the compensation model. The first of which is the brokerage model. Under the brokerage model, the financial advisor is paid a commission for introducing products into your portfolios. Many would call this sort of the old school or legacy commission-based model, where the financial advisor would get paid an upfront commission as well as a much smaller ongoing trail commission for introducing actively managed mutual funds into your portfolios. Under the brokerage model, your advisor is generally selecting the individual investments that are in your portfolio. The second type of portfolio management is the advisor managed account. And in this model, typically this is an assets under management model, wherein the advisor is individually selecting each of the investments in all of your portfolios. This might be comprised of actively managed mutual funds, passive ETFs, commonly referred to as exchange traded funds, or individual stocks and bonds. Sometimes the advisor will pay a subscription service at their own cost for guidance and insight into different economic trends. And sometimes the advisor quite simply is leveraging her or his own expertise and credentialing in building out custom portfolio models for their clients or for each individual client. However the advisor approaches the implementation of this model, the advisor is ultimately selecting and managing each of the individual investments in the client's portfolio. The third type of portfolio management model is the home office model. In this model, the financial advisor outsources, or said differently, delegates the management of the portfolio to the research team in the home office of whatever broker-dealer or registered investment advisor they use. This typically comes with an additional cost. Some advisors roll this cost onto the client, and some advisors choose to pick up this cost. Regardless, this is a model wherein the financial advisor outsources the portfolio management to research analysts in the home office. One thing to consider is that if your portfolio is non-qualified, meaning if it's invested with after-tax money, or said differently, it's not a retirement account, meaning it's a brokerage account, the management of that portfolio at the home office level does not take your individual tax return profile into consideration. the customization of that portfolio is not done in a way to try to plan unique to your tax return profile or your tax planning needs. So all clients who have that portfolio model within their investments will all have the same transactions. Therefore, it's really important to understand that if you have a high taxable income or if you have a complex portfolio with multiple holdings in a taxable account, you might actually want to have your advisor select the individual investments instead of delegating the management of that portfolio to a home office. The fourth type of portfolio management model is the separately managed account, commonly referred to as an SMA. In this model, the financial advisor outsources the portfolio management to a third party that is not in the home office. It's important to know that these separately managed account managers often charge an additional cost, sometimes as much as 1%. So it's important to understand if this adds an additional layer of fees to your overall financial planning experience and to the management of your portfolio. The SMA managers do not manage unique to the individual client's tax return, meaning the SMA manager doesn't look at each individual client's tax return and use the tax return as the basis for buying and selling individual holdings within that portfolio. Rather, each client that is in that portfolio will have all the same trades in a given year. So while it's easier for the financial advisor to delegate the management of the portfolio or some portion thereof to the SMA manager, it comes with an additional cost, and that manager is not managing unique to the client's tax return profile. Because SMA managers are not managing unique to the client's tax return profile, it's really important that we talk about tax smart investing. One of the things that I commonly saw in my former career when I traveled around the country full-time to consult wealth managers and financial advisors at almost every firm you've ever heard of is that very few of them were actually using a client's tax return as the basis for managing their taxable profile. Categorically, there are two buckets of money, to keep it simple. There's qualified, which means qualified for retirement, 401k, traditional IRA, Roth IRA, and the like. And then there's non-qualified, which means that it's not a retirement account. Many investors will understand non-qualified accounts in the context of being brokerage accounts. Even though they might not be paying commissions, because typically brokerage is associated with commissions, much of the public understands that a brokerage account is a non-retirement account. Well, in these accounts, the buying and selling of the individual investments have tax implications. And furthermore, many of the investments themselves will often come with tax ramifications.